Hello there, MSL here, and welcome to day number 6 of the Financial Reporting Crash Course series targeted at those who are sitting the May 2021 Financial Reporting exam. This session is focusing on the preparation of the Statement of Cash Flow, or as some people call it, the Cash Flow Statement. Now, you realize I've given a whole day or dedicated a whole crash course session to the cash flow statement, meaning it's very dear to my heart. And why is this the case? Over the years, the trend has been the examiner does not test the preparation of published accounts that have to do with the income statement and the financial position statement in the same year if he decides to also test the cash flow statement. What I mean is, if the cash flow statement appears on your paper, then you are not getting the traditional published accounts question on the statements of profit or loss and other comprehensive income and the statements of financial position that you are used to. So your usual trial balance with the notes will not appear in a year the examiner decides to test the cash flow statement. Now you may be aware that this syllabus has been around since just 2019. So this current new syllabus, ever since it was launched, we've not really had a cash flow statement being tested. The last time the cash flow statement was tested was, I think, in November 2018. It was question 3, and even that it was for the preparation of cash flow statements for a bank. So that was not even your usual cash flow statement for an everyday trading business or a service business, but it was for a particular industry, that's the financial services industry. What does this mean? I think it's high time the examiner tests cash flow statement, and I don't want any of us who attend this crash course session to be surprised if a cash flow statement shows up as your question 3 instead of the usual trial balance for you to prepare accounts, or for given draft accounts for you to redraft based on notes. So we will prepare the cash flow statement today. And because we've not had any too much of a recent question from the cash flow statement under the ICAG, I went to our colleagues, the Association of Chartered Certified Accountants, that's ACCA, and I took an ACCA past exam question on cash flow statements, which should do justice when it comes to understanding the principles and concepts of cash flow statements. So we saw an ACCA past exam question on the statement of cash flow. Now, before we begin, I'd like us to do something that we've not done before. I'd like to know where we are watching from, right? So just type which part of the country you're watching from, wherever you are. So if you're in Accra, you are in Kumasi, wherever you are, just let me know, just to have an idea of who is watching from where. So just give me an idea. So in the live chat, just type where you're watching from. Let's give ourselves an idea. Let's know how connected we are, right? So just type where you are viewing from, so we have an idea. So just take a few seconds to just type where you're watching from, and we will move from there. So like I said, this is an ACCA past exam question, right? So taken from our sister body or brother body, right? The Association of Chartered Certified Accountants. And you can see this is their full paper, right? Back then, when they were not testing using a combination of multiple choice and computer-based exams and all of that. Okay, so this is the question. It's called Kingdom, and it's a public listed manufacturing company, right? So what we have here is that they're saying that Kingdom is a public listed manufacturing company. Its draft summarized financial statements for the year ended 30th September 2013, and its 2012 comparatives are, so they gave us a number of financial statements to prepare the cash flow statement. What is our requirement? So we are required to prepare the statement of cash flows for Kingdom for the year ended 30th September 2013 in accordance with IAS 7 statements of cash flows using the indirect method. So you must be aware that cash flow statements are really governed by one standard, which is what? IAS 7, which deals with statements of cash flows. Now, IAS 7 is not a standard I will encourage you to read, because really What you need IAS 7 for is what goes into a cash flow statement. That is when it comes to preparing a cash flow statement, right? So once you know the format of a cash flow statement, you are good to go. Now, a quick revision or a quick refresher of the cash flow statement. What goes into the cash flow statement and what is the purpose of the cash flow statement? Now, the cash flow statement is prepared essentially to find out how cash and cash equivalents have moved over a period. So the purpose of cash flow statement is to aggregate or segregate a company's cash and cash equivalent into three main sources and explain how these have moved over time. And IS 7 gives us detailed guidance as to how to prepare the cash flow statement. Now, with respect to the cash flow statement, there are three main sections. We have the cash flow from operating activities. We have cash flow from investing activities. And we have cash flows from financing activities. So these are the three main cash flow sections we have. If you want to remember, I can just have an acronym OIF: operating activities, investing activities, and financing activities. So these are the three main sections of the cash flow statement. How do I know what goes under operating activities? How do I know what goes under investing activities? And how do I know what goes under financing activities? So, to recap, IAS 7 Statements of Cash Flows has given us clear guidance that when it comes to these three sections, let's even start from financing activities. Financing activities will typically relate to what? All items of cash flow that have to do with the sources of finance of the company. So if you look at a company's capital structure, you typically have what? Equity financing and debt financing. So with respect to these two financing sources, that is equity and debt, all changes in cash that relates to your capital structure will go to financing activities. What I mean is when it comes to all cash inflows and cash outflows that have to do with what? Raising equity or making payments that relate to equity, or when it comes to all cash inflows and cash outflows that relates to debt instruments, i.e. sourcing debt or making payments or discharging payments that have to do with debt, will all fall under financing activities. So take note, everything that has to do with the company's capital structure, cash flow wise, will go under financing activities. When it comes to investing activities will have to do with cash inflows and cash outflows that have to do mainly with non-current assets. So if you have any, let's say, tangible non-current asset, any cash outflow incurred to acquire a non-current asset will technically be under investing activity. Any proceeds you generate from selling or disposing of non-current assets will also fall under investing activities. So take note the list is not exhaustive. When we come to operating activities really will be everything else, right? But operating activities, the standard gives us two main approaches. You can either use something called the direct method or the indirect method. As the name implies, the direct method is direct. So you actually use proper cash flows. What I mean by proper cash flows is, let's say, payments made to suppliers, amounts received from customers, payments for salaries, payments for expenses. Like your real cash flows will be what will go into another operating activity. That's actual cash flows, right? That'll be direct method. Another indirect method, we start with profit before tax and we adjust for non-cash items to arrive at something that is close enough to cash. We take out our working capital adjustment and then we less out our interest, our tax, in some cases dividend paid, and that will give us our cash flow from operating activity. So take note, the only difference between the direct method and the indirect method is under the operating activity section. And the investing activity, and financing activities, they are both the same, but under in operating activities, they will differ. One last thing to mention before we start the question is that examiners over the years have 99.9% of the time asked students to prepare cash flow using the indirect method. I'm actually yet to see an exam where the question said prepare using direct. What I've seen is they ask you to prepare indirect, and then maybe the B part to say prepare the operating activities section using the direct method just for examiner to see for minor marks. But I'm here to see a full-blown cash flow question that was purely on the direct method, right? So you have a 98%, let me even give some margin of error. You have a 95% chance of having an indirect method question as opposed to a direct method question. So what we'll do today will be based on the indirect method, which is even more likely to appear on your exam question. So as we start this question, when it comes to cash flows, there are two main approaches out there. Some people decide to use T accounts to prepare the cash flow or to do the workings. What I mean is they use a traditional T account, make their adjustments here, and then maybe if there's a balancing figure here, that becomes the cash flow. I will be using a statement and not a T account. But what I mean by statement is I have a standard working that if you follow and you adapt to your own style, you should be able to play with any cash flow notes they give you in the question. So nothing to worry about. It's quite easy. It's quite intuitive. For me, my statement will be to find any cash flow, I pick the opening balance, I less the closing balance of that thing I'm looking for. Something happens. So something happens, which could be positive or negative. And then the resulting figure is my cash flow. That's all. So my opening, less closing. Something happens, and that something will be given to you in the notes of the question, right? So something happens, you adjust for it, and then the difference will be your cash flow. Now, when I say opening and closing, in every single cash flow question, what they do is, at the minimum, they'll give you two income statements. Actually not. They'll give you two statements of financial positions and one income statement. At the minimum. Some questions will give you two income statements. I think this one gave us, yes, two, right? But the norm, what you usually see is that what they give you two balance sheets, one income statement. That is what you'll be used to seeing. Two balance sheets, one income statement. Last year's and this year's, right? But like I said, and I mean, this question is a testimony or testament to this fact, you can sometimes get two income statements. What I want to reiterate to you is that cash flow is very easy. Unlike the published accounts where you have a trial balance, you need to think about IFRS, adjust something, pass double entries. Cash flow is very mechanic. If you know your stuff, actually you begin to wish that the examiner will test you on cash flows because you're like, this thing is so easy, right? So my job today is to show you that it's easy, that there is a method to do cash flow, and if you follow this method, easily you pass this question. And by pass, I mean getting 14, 15, 16, 17 over 20. And if you're lucky, maybe 19 or 20, right? It's very easy. And cash flow is the only question where you can balance it before you start. So I'll show you a little trick where you can balance your question before you even start the cash flow statement. So that if you don't even balance it in the end, you have the balancing figures correct, which will give you marks. Don't forget, the examiner gives marks for those balancing figures at the bottom. So I'll show you how to get those balancing figures correct every single time, so that whether or not you balance it, you still get marks for the balancing figure anyways, right? So let's start. You're saying Kingdom is a public listed manufacturing company. Its draft financial statements for the year ended 30th September 2013, and the 2012 comparatives are, so we have the statement of profit or loss and other comprehensive income here. Okay, give me a second. Statement of profit or loss and other comprehensive income for the year ended. So we have 2013 and 2012 here. Perfect. So you have revenue, cost of sales, gross profit. Nothing new, right? This is the same statement of profit or loss we are all used to seeing. Yeah. Then they give us the statement of financial position as at the same date, 30th September, we have for 2013, we have for 2012. Nothing new. We have assets, non-current assets, PP, investment property, current assets, inventory, receivables. Same old, right? Nothing new. And then we come to usual the additional information, right? So they give us 3 paragraphs. And the good news is cash flow doesn't have as many notes as you see in the published accounts. In fact, I've seen so many cash flow questions. I saw a very old ICA cash flow question that did not have any notes at all. It was 2 balance sheets, 1 income statement, and schedules to the financials. What I mean by schedules is that they're the notes, right? So they give you additional information on, let's say, the breakdown to a certain figure. No notes at all, no additional information. All you had to do was what? Adjust the figures, move them around, and prepare the cash flow. So thankfully, you won't see a cash flow question that has what? The number of notes that you see in a traditional published accounts question. That will not happen. Always straightforward, always straight to the point. If you know what you are doing, you should pass cash flow easily. So let's look at the 3 notes here. Let's read through them and see what the examiner is asking us to do. The first one is saying that on 1st July 2013, which date is that? Let's remind ourselves, we are required to prepare the statement of cash flow for the year ended 30th September 2013 using the indirect method, right? So if they are saying that on 1st July 2013, they acquired a new investment property, which date is 1st July 2013, you can clearly see what? It is within the same financial year, actually just 3 months before year end. So just July, August, and the month of September. So roughly 3 months. They acquired a new investment property at a cost of $1.4 million. On this same date, it also transferred one of its other investment properties to property, plant, and equipment at its fair value of $1.6 million. So they did a transfer as it became owner occupied on that date. So here you can see they are testing the principle in IAS 40 investment property. If you remember, during our financial reporting crash course sessions, especially on the IFRS deep dive, I mentioned that when it comes to investment property IAS 40, the rule is that when there is a change in use, you are required to transfer from the relevant class to the other class. And if you check this channel, there's an IFRS summary video on IAS 40 investment property. If you're a bit rusty on that standard, take a look at that. But the principle is that if you begin owner occupation of an investment property, they are required to transfer it from IAS 40 investment property and you transfer it to IAS 16 property, plant, and equipment. And technically, what you do is you will transfer at the fair value on the date of transfer, right? So here they're telling us that they transferred investment property to PPE at their fair value on that date of 1.6 million because it had become owner occupied. They had begun to use the investment property for the business or in the production or supply of goods or services or for administrative purposes for this particular company. Yeah. And they're telling us that this company adopts the fair value model for its investment property. What this means is that, under IAS 40 investment property, all investment property will be initially measured at cost, and then the standard provides 2 subsequent measurement models. We have the cost model, where the investment property will be carried at what cost, less any depreciation and impairment losses. That cost model is the same cost model under IAS 16 property, plant, and equipment. Model number 2 under subsequent measurement for this standard is that investment property can be carried at or measured at the fair value model. Under the fair value model, the investment property is revalued to its fair value measured under IFRS 13 fair value measurement. But take note, this investment property is not depreciated. Once you choose to use the fair value model, you stop depreciation of the investment property. All you do is that every year end, you ask yourself, what is the fair value of this property? Then you remeasure to fair value. Take note that all gains and losses on investment property fair valuation will go straight to profit or loss. So I'm expecting that somewhere within profit or loss in this question, we should see somewhere that there's a fair value gain or loss on investment property. Please take note, you do not treat the fair value model the same way you would have treated what the revaluation model under IAS 16. IAS 16's revaluation model will go into revaluation surplus in equity, subject to what some criteria, if there was a prior year decrease and all of that, right? But that's not the subject of today's session. So we know that they have done some transfer from investment property. I'll show you how to account for that when it comes to cash flow statement. Next thing we need to know is that Kingdom also has a policy of revaluing its other properties included as property, plant, and equipment to market value at the end of each year. So here they're telling us that other comprehensive income and the revaluation reserve both relate to this property. So they are saying that at the same time, apart from its investment properties, which are subsequently measured using the fair value model, their property, plant, and equipment under IAS 16 is subsequently measured using the revaluation model, which I've said already, that's not the same as the fair value model. So we should see some elements of a revaluation surplus and some elements of a fair value gain or loss in profit or loss, right? And then final note is depreciation of property, plant, and equipment during the year was 1.5 million. So our depreciation was 1.5. An item of plant with a carrying amount of 2.3 million was sold for 1.8 million during September 2013. So this is the information we have. In addition to this information, we've been given 2 statements of profit or loss and 2 statements of financial position. Our job is to bring all this information together to prepare the statement of cash flow. And like I've said, it's very easy. Cash flow is so easy if you know what you are doing. So after we do this question, what I would encourage you to do is to please pick it up yourself and try to practice on your own to see if you can do this. And you should be able to. It's nothing difficult. All right. So let us begin. So back to where I'll be doing our work. This company is called Kingdom. Or even like I do it all the time, right? Let me do this. I will need to split. So like I always tell you, right? In the exam, leave one page for your statements and what? Another page for your workings. So what I'll do is let me create something like this. I'll do my workings here. And then the main statement will come in. So this is for Kingdom. And the question said I should prepare what did they say? I want the exact wording, statement of cash flow. Okay. So I'm preparing the statement of cash flows for the year ended 30th September 2013. So if you remember, I told you that we have what? 3 sections. The acronym I gave us was what? OIF, operating activities, investing activities, and financing activities. Now for cash flow, I recommend strongly that what you do is to open all 3 sections concurrently. What do I mean by this? Set out your operating activities, set out your investing activities section, and set out your financing activities section at the same time. What this will do for you is that as you go through the question, you will come across information that will feed into different areas of the cash flow. As and when you find information, then you drop it in the statement. Take note that cash flow does not have a formula. It is very easy, but you just need to know which figure to pick and put where. So we're going to open our operating activities section, our investing activities section, and our financing activities section. As and when we come across information that is relevant for any of these sections, we will place them there at the same time, such that by the time our time is up for this particular question, we would have put in enough information to pass this particular question and be well on our way to passing the exam. So let me start my first section. So I'll create a section called cash flows from operating activities. Right? So I can say everything here is in thousands of dollars. Just like in the question, is it? Yes, in thousands of dollars. So I have my operating activities. How much space you leave is really at your own discretion. What I can tell you is that historically, from questions I've seen, the operating activities section is the largest, followed by the investing activities, which is usually half of the operating activities. And then the financing activities is the smallest, which is usually half of what the investing activities. So as a guidance, you can leave maybe half your page for your operating activities. Then you can leave half of that amount of space for investing activities, then half of the space for investing activities for your financing activities. That is usually the trend I've seen from experience, right? Alternatively, in the exam, you're not going to be penalized for using your space as you want. So you can leave your whole first page for the operating activities, and then you share the second, you share the second page between what the investing and financing activities. In that case, if there's a spillover, if the question tends to have more information than usual, you will not be struggling to bump or lump things together, right? So here, I have my operating activities here. Let me scroll down a little bit. Let me see. I can put my, okay. So I can somewhere here. Then I'll say cash flows from investing activities. I underline. And I know I won't need too much space, so I can bring my financing activities right here. So somewhere here is fine. Cash flows from financing activities, right? Okay, so I have my cash flow section set out neatly. What do I need to do now that I have this particular layout done? Remember I told you that for cash flow, you can balance the cash flow before you start the question. What do I mean? Now, I'm sure if you've seen a format for cash flow before, which I bet you should, I mean, this is just revision we are doing, so I'm not yet just teaching you cash flow afresh, right? You know that at the bottom of the cash flow statement, there are three lines. The first line is a net increase or decrease in cash and cash equivalents. Then the next line is what? Cash and cash equivalents at the start of the year. Then the final line is cash and cash equivalents at the end of the year. The whole purpose of the cash flow statement, ladies and gentlemen, is to explain the movement in cash and cash equivalents. So the hack I'll give you is that in the end, when you sum your operating activities plus investing activities plus financing activities, it should give you the movement in cash and cash equivalents for the year. If you know that, then all you need to do is find the cash and cash equivalents figure at the start of the year, find at the end of the year, find the movement, and place those three figures at the bottom of your cash flow. Ladies and gentlemen, if you do this, you have 3 ticks even before you read the question. This is to guarantee you that you will never get 0% in cash flow. You can get 0/20 because at least you balance the bottom part before you start the question. So let me show you which figures to pick, and it will always follow, right? So please watch carefully. So let's come investing, financing, right? After financing, you have something called, so you can just write something like, this is going to be a net increase or decrease. I'll fill it out very soon, so don't worry. Net increase or decrease. Let me use little space. So I'll fill it here, right? Net increase or decrease in cash and cash equivalents. I'm sure I need to clean this guy. Then my next line will be what? Cash and cash equivalents at start of year. Then my final line will be cash and cash equivalents at end of year. So your cash flow statement will seek to explain these things. Well, my workings even fit here. They should. Let me clean this line as well. Okay, perfect. All right, so now let's come to the cash flow statement itself. I mean, the question they gave us. So please watch carefully. Come to the balance sheet. And I like this question because it introduced the twist that you may not get in some questions. This is the perfect scenario. Watch here. Look under your current assets. Can you see bank? For 2013, bank is what? Nil. But for 2012, bank is what? $300,000. So it means that they had a bank balance of $300,000 in 2012. 2013, the balance was what? Zero. But don't end there. Always check your current liabilities to see if you have a bank overdraft. So here we have what? Bank here. And that's clearly a bank overdraft. You can see they have an overdraft of what? Right here, it's $200,000. Year started was what? Nil. So it means that they started from a positive position, cash and cash equivalent wise, of what? $300,000. And then they came to an overdraft position of what? $200,000. Ladies and gentlemen, all we are going to do in this question is to try to explain the move from positive 300,000 to what? Negative 200,000. That is all. So, do you agree with me that at the end of the year, which is 2013, cash and cash equivalent was what? Negative $200,000. So, what I'll do is I put here end of year, I put here negative $200,000. That's all. What is the start of the year figure? Remember, I told you it's going to be what? Do you remember? The figure here was what? 300, right? Right here, 300. So all I'll do is I'll put at the start of the year what? 300. Then my job now is to ask myself, how has this balance moved over the year? Right? So let's ask ourselves the same question. What will happen? So in fact, this is clearly what? This is a net decrease. We've established as a decrease. So in every question, please ensure you do this, right? But now we know in this question it's a net decrease, because if you had 300 and you've fallen all the way to 200 negative, then it's a decrease. But how much have you decreased by? Let's do the math, right? If I want to find out how much I've decreased by, it will simply be what? Let's do a quick working here. My year end is what? Minus 200. Minus year start of what? 300. That'll give me what? Minus 500. So my net decrease will be what? Negative 500. It means it must have fallen by negative 500 for me to get to what? For me to move from positive 300 to negative 200. Ladies and gentlemen, all we've done here is to establish that no matter what the case is, if I add my operating activities to my investing activities to my financing activities, it should give me minus 500. And rest assured, you will get a tick for this, a tick for this, and a tick for that without even reading the question, right? This is a guaranteed way of doing this. So in some questions, you realize that the examiner will tell you that there are no overdrafts. So everything you just be based on what the cash and cash equivalents and the current assets. So that one you just pick the opening and the closing, and the movement will be your net decrease or increase. And then you put the opening balance here and you put the closing balance here. Very simple. Please do this every time before you start your question. It's an easy way to pick up marks. Okay, so let's continue. So with cash flow, remember I told you that it's all about three sections: operating activities, investing activities, and financing activities. Since we are using the indirect method, we always start with profit before tax. Take note, we always start with what? Profit before tax. So let's all write here. The first kind of operating activities will be your profit before tax. And this figure is given to you. you get a free tick for picking this figure and dropping it here. That's why I say cash flow is very easy. So let's go to the income statement. Let's look for profit before tax. So for 2013, you can see right here, right? This is it. Profit before taxation is what? 2,400. Agreed? So we just pick that 2,400 and drop it in this question. So we'll put here 2,400. That's all. Right? 2,400. Okay. Next thing you need to do is to make adjustments for non-cash items. So you just write something. Adjustments for, right? So if you are going to adjust all the things that are non-cash, examples include depreciation, amortization, right? All those things that you don't pay cash for but that are charged to P&L, you adjust for. So one thing that is almost constant in every cash flow question is there will be some depreciation. So let's make our first adjustment. So adjustment for depreciation, right? We can even have two columns. Let's create one more column here. This is thousands of dollars, right? So how do we find our depreciation figure? It should be given to us in the question somewhere. If not, we can find it easily. So let's go through to the notes. Okay, oh, here it is. So look at the last paragraph. They said what? Depreciation, can you see, of property, plant, and equipment was what? 1.5 million. So all I'll do is I'll come here and I add back 1,500. Take note, the rule under the adjustment section is add all expenses less income. So please, under the adjustment section, where we are adjusting profit before tax, take note, it's not cash flow, it's just adjustments to profit. All we do, the rule here is to add back expenses and we less incomes, if any. So here, because depreciation is an expense, we are adding back. Please remember this, right? We add expenses and we deduct income. So we add back depreciation, okay? What else must be adjusted for? If there's any profit or loss on disposal of an asset, it is also adjusted or added back. And the reason is simple. If you dispose of an asset and you make a loss, you have not really paid cash to anybody to pay that loss. What I mean is, if you buy an asset for 1,000 and you sell it for 500, you have clearly made a loss of 500. But did you pay anybody that 500? No, there was no physical cash outflow. So loss on disposal and profit of on disposal are both nominal items that have to be adjusted for. So in this question, let's ask ourselves, is there any loss on disposal? I think so. The final paragraph mentions something along the lines of a disposal. So let's check this out. So here, look at the last sentence. It says, an item of plants with a carrying amount of 2.3 million was sold for 1.8 million. If something is worth 2.3 and you sell for 1.8, do you agree you've made a loss on disposal, right? So I need to what? Adjust for loss on disposal. So after depreciation, I adjust for loss on disposal. And this can be my first working one, right? So I come here, working one, I say loss on disposal. And this is simple. It's just going to be what? My proceeds. So the loss will be what? The proceeds on disposal less any what? Carrying value of the asset or carrying amount. So they said I sold it for what? Was sold for here 1.8 million. So 1,800 minus what? Carrying amount of 2.3 million. So minus 2,300. So what's the difference between what? 1.8 and 2.3? It's clearly what? 500. So it means I've made a loss of $500,000. So I come here and I put here what? 500. Simple. Loss on disposal. Are we okay? Loss on disposal. Very simple. Now that you have this figure, right? Let's even look through the question. And let me show you why cash flow is very dynamic. Whilst we are still here, I found information on what? proceeds, this figure here, proceeds of what, 1.8. And I told you that the purpose of the investing activities section, one of its purposes is to what, receive what, proceeds on the sale of non-current assets. So if an item of PPE has been sold for 1.8 million, that is clearly a cash inflow from investing activities. So I come to my investing activities and I put here what, proceeds from sale of PPE 1000 what, 800 inflow. And take note, in cash flow, brackets matter. If the answer is 1800 and you make 1800 with a bracket, the examiner will mark you wrong. They don't mean the same thing. So he's very, very strict when it comes to his brackets, when it comes to the cash flow statement. So please take note, no leniency when it comes to you mixing up your brackets around that area. It's very, very, very important, right? So you can see we are on operating activities, but we have information for what, our investing activities. So you can see from this little paragraph here, we have been able to pick up what, depreciation of 1.5 million. Then 2.3 million carrying amount has been sold for 1.8. We've picked that up as well. Let's go back to the income statement. Let me show you something. Now, between profit before tax and your operating profit for the year, any figures between those 2 points must also be adjusted for. What do I mean? So this is your profit before tax, right? And if you look up on the statement, you can see all the way, if you have gross profit, you less distribution cost, you get admin expenses, you less that one as well. What you have at this point will be your operating profit, right? So anything between PBT, that's profit before tax, and this particular place must be adjusted for. So some questions will actually clearly mention that that is your operating profit, but we didn't get that here, right? So no problem. What we need to do is that we need to adjust for finance costs and investment property movement, because those things are between operating profit and profit before tax. So what I'll do is, next thing I see here is what, finance cost is an expense of what, 600. I told you we add expenses and we less what, income under the adjustment section. So I add my what, finance cost of 600. So that is done. Next thing I see is what, investment property fair value changes, also what, a loss or negative. So what do? I add that one. So investment property I say what, fair value changes. It is what, 700 loss. So I add. Then I have what, rentals received 350. That is income, so I will deduct. So rentals received of what, they said 350. So I'll deduct that from it. Now, because of where I have reached at this particular point, I can say safely that between profit before tax and operating profit, I've picked up everything up there. And I've picked up depreciation, I've picked up my loss on disposal, right? So there's nothing in the notes that will come under this section anymore. So I can close off and move on to my working capital adjustment, right? So what do I do here? It is simple. Working capital adjustment is made up of three constants: change in inventory, change in receivables, and change in what? Payables. So let's go to the balance sheet. Pick these three balances up and see, have they increased or decreased, right? So let's come to inventory here. So you can see inventory right here. It was 3,100, then it fell to 2,300. So we know it's a decrease. So we just come here. You can leave the indent, right? I mean this, and come back to the corner of the line. So I come and say decrease in inventory. you can have a bracket to record your workings. So it is what the opening was 3,100 minus the closing of 2,300. This will give me a difference of what? I think 800, is it? Now take note that the rule I gave you under the adjustment section where I said what? Over here, that I say you add expenses, you less incomes. The rule is over. We are back to proper cash flows now. What I mean is decrease in inventory. Do you think it's going to lead to a cash inflow or a cash outflow? Let's ask ourselves this question. If you're a business and you had, let's say you were into the sale of iPhones, you had 10 iPhones and you only have 3 left, and you only have 3 because you sold what? 7. Would that give you more money or give you less money? The assumption is that people paid you cash, you didn't sell on credit, right? Would you agree that what? Decrease in inventory will lead to what? An increase in cash. In that case, we say what? Decrease in inventory leads to what? An increase in cash flow. So this is a cash inflow. We don't put a bracket around it. Decrease in decrease in inventory is an inflow. Another way you can learn this is what I do personally. Or in fact, let me finish everything and then I'll use the trick to get this faster for you. So we've done inventory. Remember I told you it's inventory, receivables, and what? Payables. So let's look at receivables as well and see, has it increased or decreased? So right here, trade receivables was 3,000. It was 3,400. It is now 3,000. So that's also decreased by what? 400. So I'll say decrease in receivables. That is going to be what? My 3,400 opening minus the closing of 3,000. So that's what? 400. Now, this is it a cash inflow or a cash outflow? Here, the rationale is that receivables are people who have bought from you and they have not paid you yet, right? So if the people who owe you have gone down, doesn't it mean automatically that they have paid you cash? Obviously, there are other conditions like you could have written off a bad debt or an impairment loss under IFRS 9 financial instruments. But here we are saying that common sense wise, if those who owe you have gone down, the assumption is that they've paid you. So your cash has increased. So this is a cash inflow. Like I said, I'll show you another way to get this right. But this is the common sense perspective that if my debtor balance goes, that means they've paid me. So I have a cash inflow. So this will not have a bracket around it. We've done inventory. We've done receivables. Next thing to do is what? Payables. So let's go to the liability section. And here we have trade payables. It was 3,900. It is now 4,200. So this is clearly what? An increase in payables. So I write here, increase in payables. Increase in payables. Okay. So with my increase in payables, how do I account for this? Simple. Nothing has changed. As usual, here, because of this change in science, it will be my closing minus 3,900. What the difference be? Simple. It's clearly what? 300. Now, is this going to be a cash inflow or a cash outflow? And once again, let's use a common sense perspective. If those I owe have increased, take note, this time I am buying from more and more people. I'm not paying them cash. I'm deferring the payment. Doesn't it imply that I have more cash in my hands as of today? I'll take that again. I have bought from more people, but I did not pay them cash. I'm buying from more and more people and I'm not giving them cash. So I'm getting to keep the cash and I'm not giving them the cash. So the company's cash flow position is getting better. So I have a cash inflow. So that is it for the working capital section. But like I said, I'll give you another way to get it right all the time. And that is through double entry. By double entry, I mean make it a transaction between inventory, receivables, and payables and cash. What I mean is, so for the first one, let's look at this one on decrease in inventory. I said make it a transaction between what? Inventory and cash, right? So let's say if inventory goes up, do you agree with me that what? I mean, if inventory decreases, what do? I will credit inventory and then what? I'll debit cash. And a debit to cash is what? A cash inflow. Cash is going up. That is why this was what? An inflow. We didn't deduct. We didn't put a bracket around. That's all. Right? Make it between that item and cash. Let's do for receivables as well. It will be a transaction between what? Receivables and cash. If my receivables decreases, receivables are assets. What do? I will credit my receivables and the debit goes to what? Cash. Debit to cash means my cash is increasing. So what? No bracket here. It's a positive, right? Cash inflow. That's all. Let's apply the same rationale to what? Our payables. Payables are credit balances. They are liabilities, right? So if my payables are increasing, what do? I will credit my payables, and I will debit my what? My cash. And debit to cash is an increase. That's why this is positive. So you can always use the common sense approach and then use a double entry approach to check. I mean, I use the double entry approach straight away. I don't bother with the I've bought more without paying, so that means I have more cash. I just say payables have gone up. That means I credit payables and I debit cash, and I know this is going to be an inflow, right? So please use this any of the methods that work for you, but take note that after your adjustment section in the operating activities right here, after adjustment, the next thing you need to do is what? Talk about your working capital adjustment, which is what? Changes in inventory, changes in receivables, and changes in payables, right? After you've done the working capital adjustment, next thing you need to do is what? Find a figure called the cash generated from operations. And to get that, we're going to sum everything from profit before tax here all the way to this figure, right? That is what will give us the cash generated from operations. So this is my cash generated from operations. So let's start summing together. So let me grab my calculator. Give me a second. Okay, it's going to be 2,400 plus 1,005 plus 500 plus 600 plus 700 minus 350 plus 800 plus 400 and plus 300. That gave me 6,850. So let me clear this. Okay, so I got 6,000. Let me even take this off. 6,850. So this is my cash generated from operations. Okay, now once I have this figure, next thing I need to deduct is what? My interest paid and my tax paid. So I come here, interest paid. That will be a working, I think that will be working what? Working 2, yeah. And then my tax paid. That will be my working 3, right? So we've not used any of our standard workings yet. No worries. We'll do that very soon for you to see. So let's find the interest paid. So my working 2 will be my interest paid. So for the interest paid, what do we do? Right? Nothing deep. Remember I told you that in the cash flow, if you remember, right here I said what? You have your opening figure, you less your closing figure, right? Something happens and then you get your cash flow. So let's do the same thing for this. Interest paid. So when it comes to finding the interest paid figure, what is the opening figure for interest in the question? You typically find this in the balance sheet if it's given, right? So if you look here, can you see accrued finance cost right here? So the opening figure is 50 the closing figure. Let me clean this other one so we don't get confused. Okay, the opening figure is 50, the closing is what, 100, right? So all I'll do is what I put here, opening 50, my closing is what, 100. Remember I said it's opening less closing, then something happens. What is the something that happens in this question? Right here, can you see? So I have finance cost in P&L of what, 600. It relates to interest, right? So I put here what, income statement, finance cost of what, 600. And take note, I don't deduct because it's a charge to this figure, right? So what would this give me? This clearly 500 plus what, 50, right? So that's clearly 550. So because it's 550 and it's interest paid, this would be outflow. And you can say I linked it to what, working two neatly like you showed in your exam, right? So 550 as your output or outflow. Next thing is working three, which is to find what your tax paid. Same approach, opening less closing, something happens. You get a cash flow, right? So what's my opening tax? You typically find this in the balance sheet under liabilities if you have a current liability. So can you see here? But I've seen a question where they had a current tax asset. So take note, it could also be current tax asset where they have a receivable from the revenue authority, usually tax credits, right? So here, can you see current tax payable? Opening is what? 1850. Can you see? And closing is what? 500. Right, so I'm going to use that same approach to do this. So my opening, I put here 1850. Closing will be what? Let's closing 500. Something happens for tax. There's something that will always happen is what? You add the income statement tax figure, which if you come to the P&L, can you see here? Income tax expense. Income tax expense is what? 600. Can we all see? 600. So that's the same figure I come and drop here. So I add what? 600 to it. So to this. So let's just net off. What will this give me? So it's going to be 1850, right? Minus 500 plus 600. And that gives me what? 1950 or 1950. 1950. And this will clearly be my tax payable or my tax paid, actually cash outflow 1950. So that's it for my operating activities, right? So what I'll do is let's pick the cash generated from operations figure, which is what? 6850 minus 550 for interest paid minus 1950 for my tax paid, and that gives me 4,350, is it? Okay, so I have 4,350, and because it's positive, right? Take note, it's positive, so we call it what? Net cash flow generated from operating activities. If it was negative, instead of generated from, would have said what? Net cash flow used in operating activities, right? But here it was generated from instead of being used in operating activities. So this, ladies and gentlemen, is our figure for what? Operating activities cash flow, right? So this is what we will add to the investing activities figure and the financing activities figure to see if we'll get a movement in cash and cash equivalent, right? So cash flow, that's it really for operating activities cash flow. Nothing deep here, you can see. It's all about the format, the template, and knowing what goes where. That's all, right? So now that we've gone through this, let's go to the note and see what else we can glean from there, right? Okay, so let's go back to the notes first paragraph. They said on 1st July 2013, I should have even picked this one up long ago, but it's fine, right? Better late than never. So they acquired a new investment property at a cost of what? 1.4 million. Do you agree with me that once they are acquiring a property and it's a non-current asset, it's what? Investing activities. So I just come to investing activities and I say what? Purchase of investment property. They acquired it for what? 1.4 million. So minus 1,004 because that's an outflow. They acquired it. They are paying cash for it, right? That's all minus 1,004. Okay. On this date, it transferred one of its other investment properties to PPE at a fair value of 1.6. So this will go to our PPE. Nothing deep for now. Okay. Now, what else must you know? There is always a standard working for assets purchased, or I mean, property, plants, and equipment purchased, right? Why am I even doing all these workings in this space? Let me do this working at the bottom here, right? Don't worry. Okay, so I think we got to this working 3. Okay, so let me do working 4 here. Working 4 is on what's the purchase of PPE. I want to know how much assets I purchased during the year, right? And the working is also standard. The same opening, less closing. Something happens and then you find the cash flow. So let's come to the balance sheet. Okay, can you see property, plant, and equipment here? 26,700 and 25,200. So my opening will be what? 25,200, right? Agreed? 25,200. Then what? I less my closing. So closing was what? 26,700. Then this is where you ask yourself, something happened, but in this question, the somethings are multiple, right? So what are the things that happened? These are the things we need to look out for, right? What are the things that happened in this particular question? So let's go to the notes. Can you all see that they said what? They transferred one of the investment property to PPE at the value of 1.6. If someone transfers something to PPE, do you agree with me that it's going to increase the value of what? My asset. So I'm going to say transfer from investment property. They said it's how much? 1.6. So I add it. It's positive, right? Then what else? They said the company has a policy of revaluing its properties, right? So let's go and find out how much revaluation has arisen on this particular good. So if you look at the question carefully, right? What do we have? Look at the revaluation reserve balance here. Revaluation reserve. Last year it was what? 2,500. This year is 1,002. Do you agree that what? The revaluation reserve has fallen, so it means there was some revaluation loss during the year, right? And it's clearly what? A figure of 1,300, right? It should be 1,300 between these two guys. So if revaluation surplus, or there was a revaluation loss, sorry, of 1,300, it means my assets would have fallen in value. So revaluation loss of minus 1,300, right? And we can't do all these things we are doing without talking about depreciation, which they gave us. They said depreciation was what? 1.5 million right here. So I bring in my depreciation because that also affects. So technically, you are bringing in everything that affects what PPE. So here is what 1,500. I deduct it, right? Then an item of plant with a carrying amount of what 2.3 was sold for 1.8. So if it was carrying value of 2.3 was disposed of, then I need to also take out disposal at net book value or carrying value. The figure was what 2.3, right? So simple. Let me just sum this up to find out how much PP was what purchased during the year. So it's going to be 25,200 minus 26,700 plus 1,600 minus 1,300 minus 1,500 minus 2,300. That gives me 5,000. So this 5,000 means that's how much I purchased in terms of what property, plant, and equipment during the year, right? So I come to investment activities. I say purchase of PPE, 5,000 outflow. And then still under investment activities, if you remember, there was some rentals received right here of 350, which we made an adjustment only because it appeared before between profit before tax and operating profit, right? But that amount should reflect under investing activities because it's what investment properties are held for what? Two main purposes: to earn rentals or for capital appreciation or for both. So if you've earned rental of 350, that is an investment inflow. So I pick this same figure here, 350 rental received, and I drop it under what? Investing activities as an inflow, right? So investment property rental received was the figure 350. This is an inflow, right? Inflow. So I think on the face of it, that should be it for my investing activity. So let's sum up as well. What does that give us? So we have what 1,800 minus 1,400 minus 5,000 plus 350. That gives me 4,250, right? So 4,250, and this is what? Negative, right? So it's an outflow. So I say net cash flow, not generated from, but what used in investing activities. So my net cash flow from investment activities will give me 4,250. So you can see so far I have operating activities and I have my investing activities ready. Let's now go to the financing activities, right? Remember I told you financing activities mainly, first thing you need to do is check your equity shares to see if there was any share issuance during the year. So watch it carefully. That's the first place you look. If you look here, our shares was 15,000, it's now 17,200. You agree that things have gone up by 2,200? So I come to finance and activities and I say proceeds from share issue. Difference is what? 2,200. So I put 2,200 here. And please take note, this is what? An inflow. Because when I issue shares to the market, I get what? Money, or I get funds in return. So this is an inflow of cash, right? What else will be under my financing activities? Look at 12% loan notes. Here, the figure is the same. If it had changed, I would have said what? We had either redeemed our loan notes or what? Gone for more. But because the figures are the same, loan notes have not changed and there's no cash flow impact necessarily, right? So what we need to do now is ask ourselves, Did they pay any dividend? Did they pay any dividend? And take note, IS 7 cash flow statements allows you to present dividend paid either under operating activities or under financing activities under IFRS, right? So it's up to you, but I think consistently examiners have preferred that students put the dividend paid under what? Financing activities, right? But it's no biggie. The standard allows you to also place under operating activities if a company so wishes. So here, we need to find dividend paid. If it is not given to you in the question, which is not in this case, let me see, working for SPP. Let me match this. Let me cross-reference this. Okay. If you cannot find the dividend in the question, which we're not given in this question, right? Dividend paid. There's one trick to always find out, which is to use retained earnings to work it out. Remember that retained earnings is the profits that have been plowed back or kept in the business. So if the opening figure plus the profit for the year is not equal to the closing figure, then the difference is most likely dividend. Obviously, there can be prior year adjustment in line with what IAS 8 accounting policies, changes in accounting estimates and errors. But here, most likely, cash flow wise, your impact will be the result of dividend payment. Let's go to the balance sheet. You can see here retained earnings, right? It was 8,700, it's now 7,700, right? So let's use, this is using retained earnings. What is my opening retained earnings? I have here 8,700. The closing is 7,700. Agreed. So what we need to do is let's come to the P&L and let's pick the profit for the year. So here, profit for the year is 1,800. So I add income statement profit of 1,008. Now let's find if the difference is 0, it means they didn't pay any dividend at all, right? So all the we have 8,700 minus 7,700 plus 1,800 will give you 2,800. So this is my dividend paid, working 5, 2,800. So this is an outflow. It's an outflow. So you can do one last check to see if every balance in the question has been used, right? If it has, then you can quickly close and say you are done with the question. So let's start with the balance sheet. Non-current assets, we use these two figures to work for purchase of PPE. We haven't used investment properties yet. I'll come to that shortly. We have used inventory under the working capital management. We've used receivables under working capital management. We use this bank figure to find the movement and the opening at the balancing part below the cash flow. Equity shares have been used to find the shares in issue or shares issued. Revaluation reserve, the movement was added to purchase of PPE. Retained earnings was used to find dividend paid. 12% loan notes, there was no movement, so we left it. Trade payables was used to find the movement in working capital under the operating activities. Accrued finance costs helped us determine our interest paid. Bank, obviously, this is an overdraft. It went into determining the opening balance. And then current tax payable was used to determine the tax balance. So you can see that with the exception of this figure right here, for investment properties, I used every single thing in the question. So it means we've covered enough ground. So let's do a quick working to see if there's something we can pick from this. So working 6. Investment properties. So as usual, our same old approach, right? Our same old approach, which is what is the opening balance, right? So opening. So let's net this off and see what we get. So it's going to be 5,000 minus 4,100 minus 1,600 minus 700. What does it give me? It gives me 1,400. And can we all see right here that what they said they acquired investment property of what 1.4 million right here, right? So that gives us a conclusion or a confirmation that that was the amount in cash. So this is not really a working we needed to do, right? It was just to confirm that we were on the right course. So on that note, let's come here and close off. It shows that we've picked everything we need to pick in this question. Okay, so 2,200 obviously minus 2,800 will give us what 600. So we have what 600 negative. So that becomes what net cash flow what used in investing activities. So that should be net cash flow used in investing activities. So if I sum my 4,350 here, this figure, and my minus 4,250 and my minus 600, will it give me minus 500? That's the question, right? Will it give me minus 500? So let's check. So I have calculator, give me a second. Minus 500 minus 4,250 then plus 4,350. So that gives me, so yeah, that gives me minus 500. So 4,350 minus 4,250 minus 600 will give me minus 500. So that explains the movement of cash flow. So ladies and gentlemen, this is how to prepare a cash flow statement, right? This is how to prepare a statement of cash flows. Key thing to remember from here is that what cash flow statement is in three main sections: cash flows from operating activities, your cash flows from investing activities, and your cash flows from your financing activities. The only way to get really, really, really good at this topic is to practice a lot of questions, like do different questions on cash flows. I'm sure just check the ACCA's website. You find different cash flow questions that are good practice, right? Obviously, this was, let me show you. So in case you need to solve this, I think this was, I just searched randomly on the internet and I found this. Yeah, so this was from their December 2013 exam. So you can pick this up and then try to solve it again by yourself, right? And then see how well you're able to fare in this particular question. So this is very good to try. And I'm saying this because if cash flow shows up in this exam, the question is, would you be able to attempt it? Would you be able to solve such a question to ensure that you pass the exam, right? So really, that's it for cash flow statement. Remember that we have how many sections? Three main sections. Quick recap, we have what? Cash flows from our operating activities, cash flow from your investing activities, and cash flows from your financing activities. What else must you know? That what the approach really is to go through questions, compare the opening balance to the closing balance, and see what else in the question has affected it and use that as a cash flow. Standard ones, remember, because it's the indirect method, you start with profit before tax, you adjust for non-cash items, work on your working capital adjustment, and then you get your cash flow. Investing activities is inflows and outflows of what? Any transactions dealing with what non-current assets. And then financing activities usually be what? Payment of dividend, payment of interest on loan, going to get a loan, raising shares, all those types of transactions, right? So that is it for those sections. And remember, like I said, for cash flow, you can always what? You can always balance the bottom portion, this part here, right? You can always balance it even before the question starts by picking the cash and cash equivalent figure in the question. And take note that, like we've seen here, dividends can form part of what a company's cash and cash equivalent. So please, cash flow, it's not difficult. If you were lost at any point, it's because you don't know the format of the cash flow statement. You are not sure what goes under operating, what goes under investing, what goes under financing, right? But apart from that, you should be very conversant with the cash flow statement and the format. Please take a look at that and attempt this question yourself again. Try it a number of times to get used to the format, to the routine, and to the procedures. And then try different questions on cash flow. Just in case the examiner decides to surprise you this exam with the cash flow statement, you'll be ready to meet him fair and square. So on that note, let's call it a day. If you found this helpful, obviously, please smash that like button and then share this video within your entire network. Day 6 has been interesting. We have one last day to go. So I will catch you on Tuesday at 6 p.m. Enjoy the rest of your Sunday evening. And I wish you the best of weeks in this coming week. Bye-bye for now.